Hey everybody, David here. It's been a while. I wanted to make sure I reached out to you, had some thoughts on my mind, and want to give you a kind of state of the union, so to speak, of what I see going on today, going forward. Good time to discuss things, a lot of things happening. It's been kind of a strange, really, last 18 to 24 months in the economy, the stock market. We came into 2022, with this inflation, war, Federal Reserve raising interest rates, stock market, down 20% to 30% in 2022. And we come into 2023, a lot of anxiety with the banking crisis and all the banks that failed. And so that was the big theme for the first quarter, first half of really 2023. And then you come into really, March and April, and after you had one of the last major failures, and the Federal Reserve injected a lot of money into the system to help bail these banks out, basically. They won't say it that way, but that's what happened. And really the market kind of turned around after that happened. And you saw the market go up pretty significantly, mostly led by technology. And so they call it the Magnificent Seven, which was the, Apple, Amazon, Microsoft, Tesla, Nvidia, these type of tech stocks that really kind of lifted the market. But what's kind of ironic is now we sit here today in September, the market is now correcting anywhere from 7 to 10%, depending upon if it's the S&P or the NASDAQ. Pretty severe correction that we're in the middle of right now. And you have the Dow, basically, after all said and done, is basically flat for the year right now. You had the bond market still struggle. Long and midterm treasury bonds are down, year to date. I was looking just before I got on air here, and long-term treasury bonds the last 3 years are down 40%. Just the average treasury bond in the last 3 years down 15%. Fortunately for us, we weren't buyers of those bonds. We're looking at those bonds now. A lot of us own short-term treasury bonds right now, which are paying us 5% plus yields right now, which a lot of you own. And so, that's been kind of a safe haven asset in the interim. I always say to clients, we're kind of renting bonds right now for certain portfolios. But the fact is, if you've been a holder of long-term treasury bonds for a while, you've gotten pretty beat up. And I see a lot of new clients that own those type of assets, and it's not been very pleasant for them. Thank God we have not really been invested in that area. Again, just started in the last year investing in short-term treasury bonds due to the yield. But want to talk about some kind of the good and the challenges that are going right now. The unbelievable part is our GDP, our economy has been growing at a clip of about 4%, which isn't gangbusters, but it's still good. It's a lot better than a lot of people thought. A lot of people, including me, thought we'd probably be in recession by now. And now that's kind of been pushed out to potentially 2024 if we have one at all. Unemployment has been really positive. The employment rate has been below 4%. I think right now it's about 3.8%, and it was as low as, I believe, 3.5%, 3.4%. So still really strong employment. Minus what's going on with a lot of things with the United Auto Workers, some of the challenges there, and you can't blame these people. I mean, I know the auto industry's had record profits the last couple of years, and so it makes sense. And it's probably a time for them to get pay raises. So whatever that means to us, it is kind of a negative in the short run because it does hurt the economy. I'm hoping that gets settled sooner than later. But the fact is that we've had a lot stronger economy than we thought we'd have, that a lot of people thought we'd have, a lot of experts thought we'd have. A lot of that, again, I believe is still a lot of the money that was given out by the CARES Act and those types of things that happened during COVID. It was over $2 trillion. And that money is still out in the system. Depending upon who you read and believe, there's still money out there. And so that looks like it's coming to an end as far as that usability, that capital, probably by the end of the year. And that will definitely cause a little bit of pain for the consumer. And then secondarily, you're looking at student loans. I mean, that's been a lot in the news. And I just read the average student loan payment is about $500 a month. That's like a car payment. And that's been deferred for the last couple of years. And now that's going to come back online, I believe in October, that people that have those types of loans are going to have to start paying those bills again. So that's kind of a headwind. You have obviously inflation still an issue. I'm concerned about oil right now. Oil now is almost $95 a barrel. It was in the mid 60s just 3 short months ago. You've probably seen gas price. I know I filled up, last week, and I think it was like $6.50 for Supreme, some ridiculous number. Nice, gas tax we have here. I think our gas tax is over $1 just on top of oil prices. But the fact is that you probably noticed that. And that's one of the reasons that Chair Powell of the Federal Reserve, one of the problems, the reason you've had this kind of sell-off in the market recently is that he talked about higher for longer, meaning he wants to keep interest rates, which were 0 18 months ago, to 5% today. He wants to keep them higher for longer. He's been saying that for a long time now, and it looks like the market's finally believing him. And even though 5% interest rates historically are not high, when you go from 0, where we were for a long time, 0 to 1% for over a decade, and then you ratchet up to 5%, that can be painful for the stock market. Now, and it's done a lot better than I thought it would relative to those higher rates. You haven't seen the corporate defaults yet because a lot of people locked in, just like your mortgages, right? Like in the UK and other countries, Australia, they have adjustable rate mortgages. Imagine if your mortgage went from 2% to 7%, which is the average mortgage rate is above 7% today. Those are drags on the European economy, some other countries. But just like your rates are locked in for your house, a lot of corporations have locked in long-term rates that are really, really low. And so you really haven't seen the impact of rising rates on corporate America yet. You've seen it more in the housing market, which is definitely kind of frozen, basically. Because people buy a mortgage. So if they have a 3% mortgage, they're not going to exchange that for a 7% mortgage, for an 8% mortgage. The only where you've seen the movement in the housing market has been on the builder side, because quite frankly, they're subsidizing and buying down the interest rates for those buyers and in the 4 to 5% range, which is probably the sweet spot where you can kind of unlock, the housing market right now. But even in San Diego, I think housing prices are down 4 or 5% from the peak, which is nothing compared to, I think they've doubled in the last 5 years, right? So all in all, considering what's been going on, the market has been pretty resilient. Interest rates are going to probably be sticky. They're going to probably be higher for longer. The Federal Reserve has a bad track record of prognosticating, so we can't put a lot of emphasis on what they have to say because they're typically wrong. Just like they said that inflation was going to be transitory, right? They were predicting that inflation would go away rather quickly. So the fact is that, we're kind of like, is the glass half full or half empty? Right now, I think we're kind of in neutral, right? Again, we have elections that are coming up in 2024. That's going to change some things. We have obviously this government shutdown that we're on the verge of right now. I was looking back, the last time we had a shutdown was 2018. And that lasted 35 days, but the market actually went up 10%. So we can't really use these issues as a way to gauge where the market's going to go or interest rates are going to go. But they are kind of headwinds that we have to look at going to the fourth quarter. The good news is the fourth quarter is typically one of the worst quarters, but it's also one of the best investment opportunities for the stock market. The September, October is typically where you get the lows in the market for the year. Not always, but we're kind of following that pattern right now. Again, the market's down from top to bottom around 8 to 10%, depending upon the index you're tracking. So I just want to give you those thoughts today. And again, if we're seeing a lot of people for review meetings, if you want to schedule a review, please reach out. And love to see you. Take care. Bye-bye.